what's up, everybody? It is Thursday, June 17th. All right, we had kind of a mixed day today. NASDAQ was up, Dow was down, S&P was down a little bit. Dollar was very strong today, and I'm going to talk about that. And gold really got hammered. And both of these things, the dollar reaction, the gold reaction, was one of these hyper emotional responses to what the Fed did yesterday. Now, the Fed did raise interest rates, okay? It raised interest on excess reserves by 0.05, so it took it from 0.1 to 0.15. That's free money for the banks, and it's free money for money market funds. And I'm going to talk about that in a second too, but the goal of that was to sustain the Fed's policy rate to keep overnight and short-term rates from going negative. As you know, with all these reserves piling onto bank balance sheets to the point where banks are actually turning away deposits. Deposits are flowing to these money market funds. They're parking the cash with the Fed in exchange for treasuries, right? The system is starved for collateral. The money market funds, they depend on the yield on those treasuries to earn a little bit of money for themselves and for their depositors, their customers. So, and this is all of, shouldn't say all of the Fed's making, but a large part of it is because they continue to buy $120 billion a month in securities. So adding $120 billion a month in reserves and then having to go through all these machinations like these reverse repos hit $750 billion, $750 billion today. It's just crazy. So they raised the rate. This is free money to the banks. It's free money to the money market funds. Gee, it would be nice if we got some free money. Somebody asked me a question, and it was a good question because I said, look, the Fed, I've been saying and I've been telling you guys, the Fed is a bank. It lends against collateral, okay? Just like any other bank. The other function that it has, of course, is its rate setting function. But let's talk about the lending, because I said the Fed can't, net spend like the Congress can, like the fiscal authority can. They lend against collateral. And then someone says, well, Mike, isn't providing interest on reserves net spending? And that is true. So I have to correct myself. Now, understand something. Up until 2008, like for years and years and years, the Treasury, U.S. Treasury, paid interest on reserves. Okay, it came from the Treasury. The Fed did not have the power to pay interest on reserves. But in 2008, Bernanke asked Congress, we're in the middle of the financial crisis at that time, and he asked Congress for the power for the Fed to directly pay interest on reserves. He felt that would be a useful tool to help in their monetary policy at the time, in maintaining their target rate and all this other stuff. So the Fed was granted the authority to pay interest on reserves. Now that's good and it's bad. But yes, that is the only net transfer that the Fed is legally allowed to do. I mean, it can't just send out money to people or institutions. It could lend against collateral. We know that. It could buy assets. So when it buys assets, it went all through this. It's taking away something in exchange for something, and it's usually they're getting a haircut on whatever it's taken away. The debtor is. But when it pays interest on reserves, that is functionally a fiscal operation. And that's the only fiscal operation it really has. And it's relatively recent. It started in 2008. So I just wanted to, make that clear. And it would be nice if we all got some free money too from the Fed. But no, it goes to the banks, and, that's just the way it is. All right, let's talk about the dollar and gold. To me, first of all, you have to understand something. Through the lens of MMT, a rate hike, again, is a price hike. Now, this was minuscule. It was 0.05, so it was really kind of meaningless. And the Fed did not say, hey, from here on in, we're going to be looking to bring the rates up. No, I mean, their dot plot, which is their forecast of their members, FOMC, they're saying, well, we could have 2 rates in 2023. So that was a little bit speeding up the timeline, because before that it was like no rate hikes until 2024. But 2023 is still a long way from now. A lot of things could happen. But let's understand something. Even in a rate hike environment, that's price setting higher, right? The cost of credit is reflected in the cost of all goods and services. When prices are increased via the interest rate channel, it raises the general price level, because all prices reflect the increase in cost of credit, right? As soon as they raise rates, what happens? The prime rate goes up, so your loan cost goes up, so everything is priced higher. That is inflationary. The funny thing is that Powell said he believes that inflation is going to be much, much lower as we go out into the future. So number one, why are you all saying you're going to hike rates? And number two, it's not going to be lower if you hike rates. You're raising the price level. Okay, Jerome? And those things are not, I'm going to say this for the umpteenth time, that is not bullish for the dollar. Rate increases are not bearish for gold. I'm telling you that. They're inflationary. So whatever happened today, yesterday and today with this, and today was just another follow through of crazy selling of currencies and gold, that's not going to last. The dollar is a rally in a bear market. You got to sell those things. Yeah, I've been saying this for 3 years. Okay, all the way back to 2018 when Trump started with the whole trade war stuff and everybody went crazy, when absolutely nothing was adjusted in terms of trade, but they acted like, the Forex market and Forex traders and investors acted like Trump, made the trade deficit go away, disappear. No, it got worse. There has been no policy change and no fundamental change that right now would say the dollar's in a bull market. Same stuff. Now, if we saw, let's say, fiscal flows shrinking, if we saw the deficit really start to come down, then I would say, hey, look, you know what? This dollar rally has legs. By the way, on that note of fiscal flows, I've been talking about we're maybe looking at some kind of fiscal cliff with the cutoff in these benefits. So far, that is not happening. And not only is that not happening, the flows are accelerating, which makes the sell-off in gold and the rally in the dollar the last 2 days even more overdone. Even more overdone. So just watch this over the course of the next, coming days and the next few weeks. I'm sure I'm going to be talking about this a lot when things will have a totally different appearance. You got to know MMT. All right, everybody, that's it for today. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.